Welcome to the International Security Driver Association Resource Center. I'm Joe Autera, President and CEO of Vehicle Dynamics Institute, and we're going to discuss making the business case and calculating the return on investment for a security driver. For decades now, the security driver has been a vital component of corporate security protection efforts, the protection efforts surrounding high net worth and ultra-high net worth individuals and family members, as well as celebrities and other at-risk individuals. In today's challenging times, we as security practitioners and professional security managers are accountable for the return on investment, the business case, if you will, of every component of our security program. How does that program overall and those individual components contribute to the success of whatever entity it is our principal is a part of, whether it be the family office, the corporation, the entertainment company? How is it that we contribute or bring value to that organization? And it's no longer enough to say, well, because we keep them safe. We keep them safe from security incidents, safety incidents, all sorts of risks. We're risk managers, and that's what we do. You have to be able to quantify what you do. The greatest challenge in the field of protection has always been quantifying the value of the protection effort. Because if nothing happened, well, what was the return on the investment? Nothing happened. Did it not happen because we had those assets in place, in this case a security driver, or because the circumstances were not conducive to those things happening? In which case, the question on a lot of folks' minds, particularly those key stakeholders responsible for every budget dollar, is, was that a worthwhile expenditure? So instead of looking at it from purely a safety and security risk management perspective, let's take a different perspective when we talk about the security driver. Making the business case. And to do that, we have to understand what it is that we're contributing. From our perspective, we're not only protecting the safety and security of the principal, we're also contributing to and supporting their productivity. To understand that business case a little bit better, let's dig down deeper into some of the numbers. Equilar and Associated Press annually survey CEOs' compensation. So in 2019, they surveyed CEOs from Standard & Poor's 500 companies, and that survey showed that across the U.S., the average compensation, which includes cash compensation, fringe benefits, stock, and stock options, was $12.9 million. Now, if you look at just New York City, you would be looking at a $14.4 million annual compensation rate for CEOs. Now let's look at the average hours that CEO is likely to work. A Harvard study conducted in 2018 found that the average CEO worked 62.5 hours per week, and he or she spent 47% of that time at the corporate office. So we have compensation and the hours worked for that compensation. The value component there is the time itself. What is the value of that CEO's time? Warren Buffett, CEO of Berkshire Hathaway, a name that most people are familiar with, I think he expressed that value pretty accurate when he said, I can buy anything I want, basically, but I can't buy time. Nor can your CEO, your principal, that ultra-high net worth individual, the patriarch of the family, that celebrity. They can't buy any more time. They have to be as productive as possible. So let's crunch those numbers. We'll take the New York-based CEO as our starting point. So if their annual compensation is $14.4 million, we divide that by 52 weeks and we find their weekly compensation is $276,903 and some change. So now let's take that weekly compensation and let's look at it from an hourly perspective. So if their compensation per week is $276,000 and change, if they're working 62.5 hours, that means they're generating $4,430.70 per hour in compensation. But what is the return for that? Are they making the company more money than that? If they're not, they're likely not going to be in that C-suite very long. Are they sustaining the family's investments and making the appropriate business decisions to maintain the wealth that that family has? If they're an entertainer, are they producing? Are they producing records? Are they producing movies? Are they making those appearances that they have to in a timely manner to keep their name out there, to promote their work? Those are the questions, and those are the things we have to demonstrate that we bring value to. So if we look at the average CEO's commute into New York City, because again, we're using the New York-based compensation figures, according to Geotab, their time to commute study in 2019 showed the average commuter in New York City spent about 86 minutes round trip per day on the road. So now you're starting to get a picture here. What would it cost us if that key decision maker, that C-level executive, that family patriarch, that asset that produces entertainment value and revenue, what would be the cost of having them drive themselves, not being able to focus on the things that bring value to those enterprises? We look at it from a daily basis. If the CEO is being compensated at a rate of $4,430 an hour, that's $6,336 worth of time and money that the CEO could be producing, that the patriarch of the family could be making key decisions, that that artist or actor could be focused on their craft as opposed to being behind the wheel. Now we take that to a weekly number. $6,336 times 5 days a week is $31,680. We're starting to talk some serious money here. Let's take that Harvard study one step further, looking at these numbers, and say, okay, that individual spends 47% of their time at that corporate office. So if only 47% of the time they're expending that 1.43 hours a day commuting, well, it's a mere $14,889 a week. Now monthly, if they're spending all of their time in the office and commuting back and forth every day, that would be $126,720 of lost productivity per month, or at 47%, if they're traveling extensively, $59,558 a month, plus some change in lost productivity. Yearly, you take that $126,720 figure, multiply it times 12, you're talking a $1.5 million loss of productivity. Even at that 47% threshold, you're talking $714,700 a year in lost productivity simply because we're not providing that transportation component. Every day, that individual whose value to the entity or organization is based on their productivity is being unproductive for 1.43 hours. And today, where travel patterns and habits have changed significantly, you are much more likely to have that individual in that car more often than 47% of the time. So that return on investment that the security operation and the overall entity that that security operation supports receives from having that security driver is a gain in productivity worth somewhere between $714 and $1.5 million. That return on investment correlates directly to that principal's productivity. That is a significant component of the business case for the security driver. The other element of the return on investment for the security driver is a tax incentive. Under IRS Regulation 1.132-5, which defines the conditions under which executives' fringe benefits are tax deductible, there is a long-standing deduction for secure ground transportation. Even in the face of the Tax Cuts and Jobs Act of 2017, which eliminated the employer's ability to deduct many fringe benefits. In fact, it led to a new subparagraph in IRS Regulation 1.132-5 that dealt with transportation and commuting benefits. 132-5L leaves fewer options available because the employer can no longer deduct expenses incurred for providing any transportation to any employee's travel between their residence and workplace. That prohibition includes any payment or reimbursement of those expenses, except as necessary for ensuring the safety of the employee. Which brings us right back to 1.132-5's exemptions for secure transportation. That exemption is found in subparagraph M. In accordance with that, the employer must, in order to receive or take advantage of the tax deduction for secure ground transportation, or to exempt the executive for being responsible for the cost of transportation as a taxable perk, they must demonstrate the existence of a bona fide security concern. Facts and circumstances must demonstrate a specific basis for that concern. It can't be just a generic concern. There has to be a specific threat to harm that employee. There has to be a recent history of violent terrorist activity in the locale where that transportation is provided. It can't just be, well, they're a corporate executive and we're concerned for their safety and security. And that comes from the IRS Executive Compensation Fringe Benefits Audit Techniques Guide, which was published in 2005. And how do we exempt our executives from that taxable perk? First off, you have to demonstrate that an overall security program exists. Now, they being the IRS, define that overall security program as the employee must be protected while at their residence, while commuting to and from the workplace, while at the workplace, while traveling for business or personal purposes, must include a bodyguard/chauffeur trained in evasive driving techniques. They must have an automobile specifically equipped for security, and it goes on to mention things like guards, metal detectors, alarms, or similar methods of controlling access to the workplace and residence. And that is right out of the working condition fringe section of the IRS code. Important to note a couple of things here. The only must-have is that bodyguard chauffeur trained in evasive driving techniques. You could, in other circumstances, at the workplace or at the residence or while traveling, you could rely on guards, metal detectors, alarms, or similar methods of controlling access to that executive. When they're on the road, you have to provide a bodyguard/chauffeur trained in evasive driving techniques and an automobile specially equipped for security, which we'll talk about a little bit later on. There are also, by the way, similar requirements for government officials. Under 132-5, another subparagraph, the security study would have to be performed by a government employee treated the same as an independent study if it's conducted by that individual who's expressly designated by the government employer as having the responsibility and independent authority to determine both the need for security and the appropriate protective security required. The security study is conducted in accordance with written internal procedures that require that independent objective assessment of the facts and circumstances. And then, of course, that government employer applies the specific security recommendations contained in that study to the employee on a consistent basis. And again, when we talk about secure transportation for those government officials, with respect to the employer-provided secure transportation, the security study evaluates the extent to which personal use, including commuting by the employee and the employee's spouse and dependents, may be necessary. And it makes a recommendation as to what would be considered reasonable personal use during that period. Regardless of whether the principal is a government official or a private individual, there is an exception to the 24-hour protection rule. When it comes to the IRS code, tax experts often refer to these exceptions as safe harbors, and they're also commonly known as loopholes. So under this safe harbor, 24-hour protection need not be provided as long as the required security study is properly concluded that 24-hour protection is not necessary and that an alternate approach is reasonable under the circumstances. For instance, if the principal is a corporate executive who happens to live in a high-rise residential building and the management company responsible for that building provides access control to the lobby, perhaps there's a doorman or security officer assigned there, the elevators are key controlled as well, then there would be no reason for the employer to replicate that because there is an alternate being provided not by the employer but by the management company for that building. However, the employer is still obligated to follow the remainder of the recommendations provided for in the security study. As was briefly mentioned earlier, Part 132.5 also requires the employer provide an automobile specially equipped for security in order to comply with the regulation and receive the tax benefit. Unfortunately, beyond that single sentence, there is not much more information available through the IRS as to what constitutes an automobile specially equipped for security. It wasn't all that long ago that some simple measures, such as installing a mobile phone in the vehicle, installing run-flat devices on the wheels, and shatter-resistant film on the windows, were considered by many to be sufficient to meet that requirement. Today, measures such as run-flat devices and shatter-resistant film may still meet those requirements. With the proliferation of personal cell phones, one may want to consider more advanced technologies such as GPS-based tracking of the vehicle to meet that IRS requirement for an automobile specially equipped for security purposes. Having said that, given how vague the rule is, this is clearly a topic that should be discussed with the principal and perhaps a tax attorney to ensure that the measures being implemented will comply with the IRS regulation. As with many parts of the IRS code, failure to comply with Part 132.5 represents some very high stakes for our principal. As an example, we look to former Senator Majority Leader Tom Daschle. When he left government service, he served on the board of Intermedia Advisors, a private equity firm. That firm provided a car and driver to former Senator Daschle from 2005 to 2007 for both business and personal use. In November 2008, the incoming presidential administration nominated Tom Daschle as Secretary of Health and Human Services, a very high-profile, prestigious position in any administration. Unfortunately, by February 2009, former Senator Daschle had to withdraw from consideration for that position, simply because, for tax purposes, he had failed to claim the services of the car and driver provided by his employer. And while hindsight is always 20/20, it should be noted that as a high-profile former member of Congress, as well as a high-profile member of the board, it may have been possible to justify providing that car and driver under Part 132.5 as a necessary business-related security precaution. But having failed to do that, Senator Daschle was forced into the rather embarrassing position of having to withdraw from a high-profile political nomination, and in the years since has maintained a much lower public profile than he had previously. So the takeaway there, of course, is make sure you are in compliance with Part 132.5 if your principal is being provided a car and driver. So that concludes our presentation on making the business case and calculating the return on investment for a security driver. If you have any questions regarding making that business case and calculating that return on investment, feel free to reach out for me at the email address that appears on the screen. And as always, we would urge you to continue to use the ISDA Resource Center and the tools it provides for your professional development.